Few days back, Netflix had their earnings report, and to be honest, they were decent. The stock price, however, did not reflect the numbers that Netflix reported. Those numbers even beat Wall Street's expectations. So in this video, we will take a quick look at the earnings report, look at Netflix fundamentals, and why investors reacted this way to the report. Let's dive in. The company had a strong second quarter, bringing 17% increase in revenue growth and 27% in profit margins. Now, keep in mind that Netflix is a growth company that pays no dividends, and these numbers are huge for a company valued at a $270 billion market cap. It got to the point that they increased their forecast predictability for the rest of 2024 for both revenue and operating margin by 1%, which for a company of this size, 1% is a lot. Now, a lot of people criticize when Netflix launched their ad tier for a cheaper price, stating that no one would pay for watching videos and ads. The bearish customers got it all wrong again. The ad business for Netflix grew 34% quarter over quarter. Netflix recognizes the importance of the ad tier, which brings two important components for the growth of the business. One, it enables the company to offer lower prices to consumers, and two, it creates an additional revenue and profit stream for the business. The ad business is still expanding, and given the sustained progress, Netflix believes they will achieve their ad subscriber scale for advertisers in 2025, creating a strong base from which they can further increase their ad membership in 2026 and beyond. They recognize that their ad revenue is growing fast and becoming a more meaningful contributor for a business. Netflix doesn't expect their ad business to be a primary driver of their revenue growth for the rest of 2024 and 2025. This might sound crazy, but I disagree with the management. Right now, Netflix is having an ad supply and demand issue. The company is having so many ad subscribers that there are not enough ads to show, adding to the equation that Netflix is adding their ad tier to new countries. So all Netflix has to do is contact more advertisers and negotiate. Show advertisers the analytics of their growth in the ad business and the need for ads to refill that supply. So I do think that the ad tier will continue to elevate this company for the rest of the year and beyond, as long as they continue expanding and filling the supply. Viewer watch time is key to Netflix's success. It's the best proxy they have for members' happiness, and when people watch more, they stick around longer, also known as retention. Having high retention to a certain extent makes customers talk about the service and potentially recommend it to other users, which places a higher value on the service. On the screen, we have the Nielsen chart that shows the US TV time screen up to June 2024 and is divided into 4 segments: broadcast, cable, streaming, and other. Netflix goes into the streaming category of 40.3%. Out of that percentage, Netflix represents 8.4%, just behind YouTube, which accounts for 9.9%. Netflix and YouTube compete for people's time and attention. Comparing Netflix to the other paid streaming services, Netflix is the clear winner here, and by a huge margin. As time goes on, I see the shift of streaming to continue to grow while cable and broadcast reduces. Cable is expensive, outdated, and simply is not keeping up with the changes of today's technology. In my opinion, Netflix and YouTube will continue to dominate. The high quality content from Netflix drives more viewers and attention, while the creator economy on YouTube brings more people to continue creating fresh content. Now, let's take a look at the fundamentals. As mentioned, the revenue of the company is growing. Even taking into account the geopolitical situation that affected them in 2022, Netflix recovered pretty quickly. If we break that revenue per region, we can see the growth of each segment. All combined, the revenue chart goes up. But if we break it down individually, we can appreciate the same pattern. So it's safe to say that individually, every region is growing on their own and the revenue is not being carried by a specific region. The net subscriber gain is the amount of people signing up minus the amount of people signing out. In the latest quarter, we can see some sort of deceleration. The people subscribing is slowing down, and this can look bad. But when we take a look at the total subscriber count, all we see is pure growth, sitting at 277 million subscribers, and it's not slowing down. Netflix stated that it will continue attracting new subscribers and expanding to new places. Something that investors don't talk about that much is Netflix content budget. From 2019 to 2024, the content budget has remained flat, and this is super important to take notes. Continuing to deliver high quality content without spending more money, and at the same time your subscriber count and revenue is increasing, positions Netflix in a favorable position to continue increasing their profit margins. For the free cash flow, this company turned it around. From 2014 to 2019, they had a negative free cash flow and had a stock-based compensation increasing over time. Stock-based compensation pushes the free cash flow more into the negative. Fast forward to 2020, Netflix was able to start tapping into the positive free cash flow and reducing the stock-based compensation, and the company has been able to maintain it. So what is going on? Why the company did not go up in value after reporting fantastic earnings and the fundamentals are on point, literally in the right direction? Did I miss something? Why did investors not react in a positive tone? The company increased their forecast for the year. Even with foreign exchanges, the forecast remains optimistic. The company is expanding, gaining subscribers, increasing margins, and the ad tier is bringing heavy revenue. The only thing that could come to my mind is that they're forecasting less people subscribing next quarter. That's it. I know Netflix relies on subscriber gain to increase their revenue, but there's other ways to increase the profit margin. For example, reducing the content budget and increasing the supply for ads. That can offset the net subscriber next quarter, in terms of gaining less subscribers but made more money. Overall, I really don't see a bad problem that could alarm investors to react the way they did this quarter. Netflix looks like a buy from what I'm seeing. That's going to be it for this episode. Don't forget to subscribe, like, or even drop comments. Thanks for watching, and I'll see you in the next one.